mode.
Hello everyone and welcome to today's webinar. Today we're going to be covering everything that you should know to secure business financing. We're actually going to be talking about at least 7 different things that you should know to be able to obtain business financing. We're going to kind of give you the ins and outs. The reality is there's a lot of money that's available right now, but a lot of people don't know how to get it. It's available at alternative lending sources that are outside of conventional banks, and a lot of people just aren't sure of the process to go through it. So today we're going to dissect this process. Everything from looking at an application to breaking down the kinds of funding that's actually out there, and I'm going to walk you through this process. So hopefully by the end of this webinar, within about an hour, you'll be able to then know exactly how you can go about getting funding for your business, whether you're a startup, whether you have credit challenges, whatever your situation is, there's a lot of funding or even business credit, if funding doesn't apply, that's available. So before we dig in, let me introduce myself. My name's Ty Crandall. I'm the Director of Business Services here at Credit Suite. What we do is we do a few different things. We help customers get funding, we help business owners get business credit, and we also help people that are interested offer business credit and funding as a service. There's not going to be any sales pitch this webinar today. That's all you'll hear about what we do. So if you're interested in learning more, you can check us out. There's our website, creditsuite.com/business credit, and that will give you all the information about offering business credit and financing as a service. And you can even get in touch with us through our phone number, email address right there, and we can help you with getting business credit or financing for your business or helping others do the same. So my experience, I've got about 16 years of financial experience. I've been in the business credit field for many years now. I'm probably one of the most well-known authorities in the business credit space. Our organization has helped thousands and thousands of customers obtain credit and financing, so I know a lot about this. And this webinar is really about what I've learned and about how you can not make mistakes in going through this process, because what we found is that there really is a clear-cut process to applying and getting funding. And if you know this process up front, you stand a much better chance of being able to go through the process, actually apply, and get approved. So let's jump in. First of all, let's talk a little bit about the different types of business financing. Well, there's a lot of different types of financing that's out there, and I want to start with credit lines, because credit lines are really one of the most popular kinds of funding that's out there. It's by far the most commonly requested types of funding that's out there. Almost every customer we talk to wants some form of credit line. So credit lines are what most business owners really want access to. They're also one of the hardest types of financing to actually qualify. Now, to get approved for real credit lines, you have to supply business financials in almost all cases. So there are business credit cards that you're going to learn through this webinar that you can get. And credit cards and credit lines don't have that much of a difference between actually being able to get cash out, and credit cards provide better intro rates, like 0% intro rates. But if you're talking about a real credit line for 50 grand, 100 grand, 250,000, you're going to need to be prepared to supply financials. If you're looking for a credit card with a limit of 10, 20, 30,000, you could get that without financials. But if you're talking about an official credit line that you could use with higher limits, 50, 250,000 plus, you're going to have to supply financials in those cases. Usually they're going to want tax returns for the last 2 to 3 years. Okay, you might also be asked for profit and loss statements, current projected bank statements, and business plan, and more. These are closer to full documentation kind of deals. They're harder to qualify than a lot of the alternative financing that's out there, but they are definitely available. I don't talk about them a lot because they are so hard to qualify, but they're definitely available. You just have to provide tax returns. Your tax returns have to be solid. You have to be showing good net profits. If you meet that criteria, you stand a decent chance of actually getting approved. Now, your approval amount will be based on the profits you show on your actual tax returns. So your tax returns also should show that you have increasing profits. So they don't want to see that from year to year you're decreasing your profits and decreasing your sales. They're looking to see that from year to year your sales are increased from the year before, and so are your profits. So your personal and business credit will also be reviewed when you're applying for credit lines, and both should be good to get approved. Now, don't get me wrong, okay? Don't get discouraged because we're starting with the hardest kind of financing that's out there to qualify for. We're about to dive into a lot of different kinds of financing where you don't need all this criteria to get approved. But again, as I said in the beginning slide, credit lines are one of the hardest programs to qualify and get approved for. So you do need the tax returns. You do need to have good personal credit. They will even look at your business credit to see if you have established business credit. And lenders like to see that you have open credit lines now that have very high limits. That's really, when you're talking about business credit cards, when you're talking about business credit lines, your approvals are going to mimic your current limit account now. Current limit accounts now. So if you have a $20,000 credit limit or credit card now, then that makes it easier to get approved for a $20,000 credit line. So if you're going in and applying for a $250,000 credit line and all you ever have had is a credit card with a $3,000 limit, that's a hard sell. That's very risky for the lender to lend you that much money when your credit doesn't reflect that you've responsibly handled that kind of limit before. They might give you something closer to the limit that you have. But again, don't get me wrong, a lot of this goes off of your net profits. It's just one of the things they do want to see is that you have a history of maintaining higher limit revolving type of accounts. And approval amounts might also be linked to your existing limits now, as I just mentioned. So on top of being linked to your net profits, they are going to also look to see what these high limits are that you've maintained before in the past, and you also might see approval limits similar to those versus net profit in some cases. So another types of financing are business loans. Now, business loans are available at a lot of places, including SBA loans offered from regular conventional banks. Now, many lenders also provide business loans outside of your conventional banks, and some other types of collateral-based financing also offer loans, such as book of business financing for insurance agents. So there's a few different ways you could really get business loans. You can go into your bank, Bank of America, Chase, whoever it may be. You could go through alternative lenders, private investors even have actual business loans. You can even find some kind of collateral-based financing has business loans. Some of those aren't loans, they're advances, they're credit lines, they're all different kinds, but some collateral-based financing will also offer business loans. A perfect example is a book of business financing for insurance agents. This kind of financing has 3 to 5 year loan terms that most insurance agents go with that aren't too unsimilar from what you might find with SBA. Now, many loans are shorter terms, typically 3 to 5 years, like the example I just gave you. Others might go as long as 20 years or longer. This might be an SBA higher amount, $1 million, $2 million type loan. Now, rates vary radically based on risk. So with some being 2% over the prime rate and others being as high as 10%. So rates will really fluctuate on loans depending on what kind of collateral you have and the other risk factors involved with actually obtaining the loan. So to get long loan terms, you'll also almost always need financials, and in many cases you're going to need collateral. Okay, this is very high risk. I mean, for somebody to give you 5, 10, 20-year loan, which is what you want to have the lowest payments, you're going to have financials. You're going to have collateral. As a matter of fact, for a lot of loans beyond collateral-based loans, you're going to need this stuff anyways. But the longer terms you're desiring, the more financials and collateral credit requirements are going to become a major factor to get approved. Now, another type of financing beyond credit lines and loans is called advances. Now, merchant and revenue advances are becoming increasingly common in the business funding arena. These are just like cash advances in the consumer world. They're much easier to secure than loans and credit lines, and in most cases, you could be approved with no financials at all being provided. You don't even need good credit. So you don't need to supply tax returns. You don't need to have P&L statements or any kind of really financials beyond bank statements. So any of these, these are much easier to get just by proving that you have consistent cash flow, like bank statements. So you don't need the financials. You don't need to go through all the headaches. Now, advances usually close very fast, within a week, when loans and credit lines can take 30 to 90 days. So much easier to qualify, much faster to get. And the terms aren't as favorable on advances, but the scope of who qualifies is very broad. So I always use this example. When you talk about an SBA loan, which is the most popular kind of loan that people know about, if you really think about it, how many people have you ever met your entire life who've told you they successfully secured an SBA loan? Now, if you're like most people I ask this question to, it's nobody, maybe one person. It's definitely less than 5 people. Very few people secure those loans because they're much harder to qualify for. Okay, but when you're talking about advances, these are much easier to qualify for. You don't need good credit like you need with loans. You don't need financials or positive financials of any sort like you do with loans. And you don't need to have, good credit. You don't need the financials. You don't need collateral. All those things that are required for loans, you just aren't required for advances. Now, the terms aren't as favorable. I mean, you could pay 20% or more on advances. I've seen 30-40% on high-risk deals with advances. Much different than a 5 to 10% rate that you might get on a loan. But again, it's fast, easy money. You can have bad credit to qualify. You don't need collateral. You could provide 4 months bank statements and get approved, and we've seen clients close in 48 to 72 hours. We had one client call us on Monday, couldn't meet his payroll for Wednesday. We got him in advance to meet his payroll for Wednesday when he called Monday morning. So 48 hours later, it was done. So these are very fast to get approved. If you're quick to respond, a lender can usually get you done in a week or less, in a lot of cases as little as 72 hours or less. Now, going back to advances, if you pay attention at all to business funding or in the news, there's a company called On Deck that does these kind of advances. They've started to pop up over TV, and they're now getting ready to file for an IPO, and it will be a $1 billion IPO. Google has now got behind them. So this is the most popular kind of alternative lending that exists today. And like I said, On Deck is the one company that's now come out going to an IPO with this, showing that this kind of alternative lending is here to stay. This isn't a fad. This isn't something that's going to be around short term. This is the future of lending, which is the faster, easier money with less qualifications, just because you've shown that you do good business, that you consistently bring in good revenue, and that alone is enough to get you sometimes hundreds of thousands of dollars. We did a $450,000 advance for a client, and we do $10,000 advances for clients. So it really depends on your situation. But what also is nice about advances is, beyond them being fast and easy, is you kind of prove yourself and work your way up. Like, we had one client that really had a bad situation, bad credit, bad everything. We got her $9 grand. She invested it in her business. She came back 3 months later. She used the money to increase her revenue. We got her another 40 grand. Then 3 months later, we got another 48 grand. So although she wanted 40 in the beginning and we got her 9, it ended up that we've got her almost 100,000, and she'll continue to get more because she proved herself. So a lot of people we talk to, that's what they want. They're like, look, if you just give me a shot, I can prove that I'll pay the money back. Well, advances are very good with that, with getting a shot even with credit challenges and other items that work against you like no collateral, and then proving yourself and reinvesting, growing your business, and being able to get more and more money as you continue to prove your ability to pay. So credit cards. There are a few different types of credit cards you can secure in the business funding world. Okay, most of these cards work exactly as consumer credit cards do, but a lot of them have additional benefits. So the provided benefits depend on the type of cards that you're actually securing. Okay, so there's business credit cards with no personal guarantee. Now, you can get credit cards for your business through Visa, MasterCard, Amex, Discover, that you can use almost anywhere and for almost any purpose. These cards are secured by you having a good business credit report and score. You usually need about 10 what are called payment experiences, or what a lot of people refer to as trade lines, which is like, let me give you an example. If Staples reports to Dun & Bradstreet and Experian, that would count as 2 payment experiences. So that's an account getting reported to 2 reporting agencies, would count as 2 payment experiences. So you need 10 total. And you need a PAYDEX of 80 or higher. The PAYDEX score is Dun & Bradstreet's credit score. 80 means you pay your bills as agreed. So if you have basically trade lines, an established credit profile, which you could build very quickly, it takes about 6 months to build to this level, and you pay your bills as agreed, you could qualify for these kind of no personal guarantee credit cards using your business credit to qualify, not your personal credit. So your personal credit can be trashed, and you could still qualify for business credit cards if you've built your business credit and meet this criteria. So these card limits will mimic your highest business credit account limits now, the same as we talked about earlier. This is why we have people get store credit, and places like Dell commonly give $10,000 credit limit store credits. So we always have our clients go through, build their business credit quickly, get an account like Dell. They have a $10,000 high credit limit. Then we turn around and help them get Visa, MasterCard, Discover, Amex cards for 10 grand. They pay those as agreed. Then we turn around and keep getting them 12, 15, 20, and it continues to grow. Okay, so those card limits you get approved for will mimic your highest limits on your business credit reports now, which is why you want to do a little building before you get in and start applying for these kind of accounts. Rates are very similar to consumer credit cards. No personal guarantee from you is required because it's in your business name. Now, there are unsecured business credit cards with a personal guarantee, and you can use your personal credit to get approved for these real business credit cards instead of using your business credit. Okay, so let's talk right now. Why would you want one or the other? Well, it depends on you. The holy grail in business, of course, is to get no personal guarantee business credit cards. But you're only going to accomplish that if you're willing to dedicate some time to building your business credit. Doesn't take a ton of time. In 6 months, you could build your business credit to qualify for those kind of accounts. The benefit is that you're not personally liable for your business debt, on top of a million other benefits. These accounts report to the business credit reporting agencies. They don't report to the consumer credit reporting agencies. They don't pull your personal credit to get approved. Those are good accounts. Then there's these kind of accounts. These kind of accounts are better for somebody that does have good credit, or you have a good credit partner that can actually help you. These don't require you to have good business credit, but they'll help you build business credit in the process. So the difference between what I just showed you and now is the other ones, you need business credit to qualify. With these, you need good personal credit to qualify. So you can use your personal credit to get approved. These accounts will require you provide a personal guarantee. To get approved, you must have very good credit, no derogatory items that are at least within the last 12 or 24 months, less than 2 inquiries in the last 6 months, and utilization below 30%. Utilization means what is your limit and compared to what you owe. If you have a $1,000 limit account and you owe $300 on that, then that is 30% of the limit, and that is 30% utilization. So they want to make sure you're not overutilizing your personal cards, you have very few inquiries, and you don't have any derogatory items to get approved. And if you do meet that criteria, you can get approved. Now, you typically can get 5 times the amount of credit of your highest credit limit reporting account now. So this will come in the form of 5 separate cards. So if you have a credit card limit of $5,000 now, you could usually get about $25,000 worth of these cards. If you have a $10,000 limit, you could usually get $50,000 limit cards. So you can usually get about 5 times whatever your highest credit limit account is. And these cards usually only report to the business credit reporting agencies, not the consumer ones, and they also offer intro rates of about 0% for 6 to 18 months. Now, you can reach out to us and let us know if you're interested in something like this, but these are not ones you can go out and get on your own. Like, you're not going to go out and get these kind of accounts without going through a lender that specializes in this kind of lending. And here's why. Right? Well, actually, right here's why. Because you can't get approved with 2 inquiries or more. So if you went into Bank of America and applied and got a credit card, then you went to Chase, Chase is probably going to deny you because they see the Bank of America inquiry. But there are lenders that do this in a way where they know which lenders will approve you. They know the regional lenders in your area. They'll apply for all of it at one time, and in one shot, within an hour, you get 5 different approvals, something you could not do on your own. I know. We've tried. We had a client with 8, 10 credit scores. We helped him go to his bank to apply because he didn't want to pay the lender a fee to get this kind of account. The lender could have got him $75,000. Going to his own bank, he got $12,500 approved. That's pretty common. You could go to your own bank with great credit and they'll give you a credit card, but it's usually for 1/5 of what you could have done if you work with a lender that specializes in getting this kind of unsecured credit. Now, there's also unsecured personal credit cards with a personal guarantee. Now, you can use your personal credit again to get approved for these kind of accounts, but these accounts will also require that you provide a personal guarantee. To get approved, you must have good credit, not great. Okay, you won't need as good a credit as the ones I just showed you. You can get approved with these with like 660, 680 credit scores. The other ones require more 700 type credit scores. You could get approved for these with some old medical collections, some collections on your account. You could get approved for these with utilization of 60%. With 10 inquiries in the last 90 days. So these are a little bit more lenient than the ones I just showed you. Both require a personal guarantee. Both look at personal credit to get approved, but these are more lenient on their credit requirements to get approved. But the difference is that they report to the personal credit reporting agencies, not the business credit reporting agencies. And again, you could typically get 5 times the amount of credit that you would normally get. And again, it comes in the form of 5 different cards. So 3 similar programs. One has no personal guarantee because you have business credit established. That's how you got it. The other one does have a personal guarantee because you're using your personal credit to qualify. Your personal credit has to be stellar, and they report to the business credit reporting agencies. Then there's personal cards where you can get with a personal guarantee. Also, they report to the consumer credit reporting agencies, not the business, so you can't build your business credit in the process. But the benefit is it's more lenient to actually get approved. So these are more closer to the credit cards you'll normally see out there in places. But again, you really want to work with a specialized lender that specializes in this, because if you don't, you'll probably get about 1/5 of what you could get without a lender that actually knows what they're doing in this space. So applying for business funding, the secrets of the application. Now you have kind of a real general idea of the kind of money that's out there. Loans, credit lines, credit cards, really almost in advances. Almost everything you're going to find out there, whether it be asset-based lending like collateral-based lending or 401k financing or an SBA loan or whatever it may be, fits into one of those buckets I just told you. And now knowing these buckets makes it a little bit more easy to separate this and know what kind of financing you're applying for. Now, if I'm moving kind of fast, it's because it's just the way my brain works, and I have a tendency to move fast, talk fast. So don't worry. By attending this webinar in its entirety, you'll get a playback of this webinar. You can stop, pause, go back, write down anything you missed. So if I'm moving a little too fast on some things, don't worry. You will get a chance to go back and revisit this. So, applying for business funding, the secrets of the application. Well, here is our typical application for a customer. Okay, this is an application that one of our customers would actually fill out to come in and get financing, and it's a general application that really works for asset-based lending and everything else. So you can kind of get an idea of exactly what's on the actual application. And we're going to talk through a lot of these lines, because when you look at this, you say, great, Ty, thank you. You showed me an application. That's amazing. But that doesn't really help you any. So what I want to do is dissect this application, because every line item on an application is being asked for a very specific reason. The problem is, if you don't know why they're asking what they're asking for, then you could very well put information that is a deterrent for them giving you money. So if you understand why they're asking you these questions, then it makes it much easier to get approved, because you can then go through and fill out the application with accurate information, but do so in a way that it's enticing for them to want to give you actual money. So company name. If you're just choosing a name, try to choose a basic or loose version of a name that doesn't peg you into a certain industry. Look, there's a lot of lending that has industry restrictions. Scrap that. All lending has industry restrictions. There's no product out there that I've ever seen that doesn't restrict certain industries. They'll say, we won't help this industry, we won't help this industry. Sometimes just because your name reflects the industry you're in could get you denied. So when it comes to business credit and financing, if you are just choosing a company name, try to choose something very general, because the more specific you get, it might help your customers know more about what you do. Just keep in mind, it does sometimes make it harder to actually get money. And I'll give you a very simple example. Like, our company name is Credit Suite, and we get all kinds of blowback on this when we apply for anything, because they think we're a credit repair company. Even though we're like in the business financing space, we're as far away from credit repair as you could get. Just because the word credit is in our name, it creates problems for us. So does that mean we would name ourselves something else? Yeah, we actually probably will change our name partially for that reason, and use another brand that we're under. But that wouldn't be prohibitive of us doing it just because we're trying to get business money. It's just something to be consciously aware of, that when your industry, your name reflects your industry, it will sometimes create problems, especially if that industry is on a restricted industry list. There are a lot of industries that fall on these restricted lists. Your name can allude to an industry, and maybe you are, or maybe you're not part of, and this can affect your ability to get approved. So, for example, the name Elite Credit got my bank account shut down just because the name led the lender to believe it was a credit repair company, which it was. So I used to own a credit repair company back in the day. I sold it, and at that time, I had a bank account with Wachovia when Wachovia was still around, and Wachovia shut me down just because my name had credit in it, and they thought I was in credit repair, which I was at the time, and they shut me down. So these are the kind of problems you could have just by your name reflecting the type of industry that you're in. Trust me, I can definitely give you feedback from that from personal experience. So general consulting type names work best, as nobody will deny you. Okay, any other industry specific name very well might restrict your ability to get money with some lending sources and credit issuers. So for example, Elite Consulting, Elite Business. Okay, that's a lot better than Elite Credit, as nobody would not lend me credit or money with a general consulting name. And this is advice we give everybody that applies for business credit. I'm not saying you need to rename your company. I'm just saying you should think about the repercussions the name could have when you're applying for business financing. This is why we dissect an application so you know what they're looking for and why they're looking for it. So these might be better names to consider. Okay, the more general the name, the better your chances of getting money and credit for your business. Now the phone number. You got to have a business phone number. Don't use a personal home or a cell phone. Yes, lenders will know. Okay, a lot of people think they can get away with this. They can't. We have technology in our business finance suite that tells you right away what it is. So if somebody enters a cell phone and says, oh, you can't move forward, you're entering a cell phone. That won't work. Enter a home phone, oh, you can't move forward, you're entering a home phone. There's technology that's simple and automated where they'll take your application without a human even looking at it, and they'll know right away whether you have a business phone number or not. So don't even try applying for money without a real business phone number. Voice over IP numbers are okay. So Google numbers, a Ring Central voice over IP number, those are just fine. Those are acceptable. Okay, you should have a toll-free number unless you only deal with local business, such as a pizza shop. Like if you're a pizza shop, you don't need a toll-free number because everybody that's calling you is local. But nowadays, most of us with the internet do business statewide, regional-wide, nationwide, and then when that's the case, they really would expect you to have a toll-free number, and you should also have a fax number. Even though a lot of us don't use faxes nowadays, we tend to use scanning and emailing and things like that. You know, most big professional businesses have fax numbers, right? I mean, there's no company like Dell or Apple or Microsoft that doesn't have a fax number. Like every large company has a fax number, so you need to make sure that you have a fax number, and your number must be listed with 411, not your fax number, but your phone number needs to be listed with 411. Now, here's one of the basic requirements most people miss. It's crazy, but lenders will deny you just because you don't have your phone number listed with 411. As a matter of fact, it's one of the most common reasons that we see people get denied for financing is because of this. It's crazy. So there's a company called List Yourself that will help you do this. You can't just go out and get listed with 411. So I'm telling you this, you don't have to learn the hard way. But a company like List Yourself can do this for you. And I would recommend trying them. It's who we run our clients through. So are you a homeowner? Well, being a homeowner increases your chances of getting approved. It shows a greater level of maturity and responsibility. Plus, it shows you can manage a higher monthly payment. And your home might even be used as collateral for some financing, such as SBA loans. So when they ask, are you a homeowner or not, that's why they're asking. The minute you put yes, you become less of a risk. When you say no and you're renting, you become a higher risk. Assets. Lenders love assets because they love collateral. So when you're asked on the application about the assets you have, what the lender's really asking about is they want to know what collateral you possibly might have to offset the debt, offset their risk. The more collateral you have, better chances you have of getting approved with a lot of different kinds of financing. SBA loans require the lender to take all assets that you have in the business as collateral, and if you still don't have enough, they'll take your personal assets such as homes. Now, I was at our credit boot camp talking about this very topic on stage, and I actually showed SBA's underwriting guidelines. SBA requires this. It's not even the lender's choice. They have to take all of your business assets as collateral, period. It's required, and if you don't have enough assets in collateral, they'll require your home. Now again, I'm not talking about all kinds of financing. I'm just telling you SBA loans in particular. It's part of the reason that they're so hard to qualify. So when they ask about assets on an application, this is what they're really asking for. So some lenders, such as advanced lenders, don't need collateral. So when we were talking about advances earlier, though they don't want collateral. They don't care if you have collateral or not, but a lot of other lenders will. But it still helps them feel more secure in lending you money if you do have assets to show. So even though it's not going to be a factor that ties into your approval, if you have assets, they still feel more secure. It still might be a compensating factor that helps you get approved if you have weak areas, other places like really bad credit. Having assets could help offset the risk and still get you approved. And a lot of things can work as collateral, and here I listed quite a few of them. 401k, stocks, real estate, inventory and equipment, purchase orders and account receivables, any other items that are easy for a lender to sell and get their money back in case of default. I had a management meeting earlier today with our team, and our funding manager was talking about a deal where the chiropractor wanted to use a piece of equipment from 1989, that was like a hair removal product from 1989, as collateral. And it obviously couldn't work because nobody wants a 30, 40-year-old piece of equipment. There's nobody out there that would want to buy that, so it's not something the lender could easily turn around and resell. So that's what they're looking for. When they're looking for collateral, they want something they could quickly get rid of if need be to get their money back. Okay, so, and I use a home as an example. When you get a home, your home is the collateral for the mortgage. You default, they sell your home. But yet they don't want to sell your home. They want you to pay the payments because, the process of going through and selling that asset is lengthy and costly. So they're really looking for the best assets they can easily liquidate when they're actually talking about assets that provide real value. Time in business. The longer you're in business, the better your chances of getting approved for almost all types of financing. And that's because extensive statistics on this show the majority of businesses fail in early years, like 3 years or less. The longer a business is open, the more chances of failing decline. Okay, so longer standing businesses have a much less risk of going out of business than long standing ones do. Okay, being open less than 1 year makes it tough to get financing. You can get unsecured personal and business credit cards, which we talked about, with no issues. But advances, even cash flow advances that just look at your bank statements, are tougher, and loans are nearly impossible to secure because, as we talked about, loans want financials. So if you've been in business less than a year, you wouldn't have those. Some business credit vendors, stores, and cash credit sources also might not approve you if you've been open for 1 year or less. So we have a lot of business credit sources like Home Depot. Home Depot wants to see that you've been in business for 3 years to give you a business credit card. You could get approved before 3 years, but they usually want a personal guarantee and other things. So whether it's business credit sources or it's financing sources, some of them, a lot of lender sources, require a year in business to really be able to get you money. 3 years or more is really what's preferred. So when they're asking how long you've been in business, just know they really are hoping you've been in business 3 years or more. If not, you still have a chance of getting approved depending on the kind of financing you're going through. I'm just telling you what's preferred, what they're really looking for. This is part of the reason that SBA loans require 2 to 3 years of financials to get approved, okay? Because they want you to be in business 2 or 3 years, so they make you supply financials for 2 or 3 years in order to be able to get approved. So, average revenue. Having good, stable revenue can be one of the main reasons you get approved for some funding products such as merchant or revenue advances. Okay, just having consistent revenue alone can actually get you approved. But almost all sources do require that you have revenues coming in for approval. Okay, a lot of the credit cards we talked about don't, but and in some collateral-based financing doesn't actually require this. But a lot of the other ones do. They want to actually see that you actually do have average revenue coming in to be able to qualify. Some sources such as personal business cards, as I just said, won't require this. Other sources such as lenders to lend or advanced lenders will verify your cash flow with your bank statements. They don't need to see your tax returns when you start talking about alternative lending, but they will require that you provide bank statements to verify cash flow. Most lenders issuing loans and credit lines will require tax returns on top of P&L statements and bank statements to verify the income. Your tax returns, again, have to show good net profits. The amount you will show will determine the amount of money you're approved for. in a lot of cases. So when they're looking for loans, a lot of times when you get a loan, the amount of money you get is equivalent to your net profit, just as we talked about with credit lines earlier. So it's something to keep in mind. You must show increasing profits from year to year, not declining profits, which we'd already talked about. Declining profits are a sign of trouble. And most lenders will run away from any deal where the applicant has revenues or profits declining from year to year. I always use Shark Tank as an example. Like, if you ever watch the show Shark Tank, they'll ask this question. I mean, what were your revenues the last 5 years? The guy will be like, I made $5 million. Okay, well, how much did you make last year? I made like $1 million. And then they say, well, how much you made this year? He goes, well, this year we had some problems and we're only going to make 500,000. And you hear every shark go, oh man, that's not good. Everybody pulls back. They don't want to see that you're declining. They want to see that you're growing. When they see you're declining, it's really a sign of trouble in most lenders' minds. Now, there are many high-risk industries lenders don't prefer. And the list of high-risk industries is different for each lender and funding type. Some lenders have been burned by one type of industry and blacklist it, while other lenders offering similar products are okay with that industry. It's actually pretty interesting. We had a very big advanced lender come down and visit us because we do a ton of volume, so they'll commonly come down and spend some time with us. So I was actually asking him, how do you determine your high-risk list? And I had thought it was an industry standard, and he said, no, it's actually not. He goes, with us, it's who burns us. So, for example, we got burned by a student loan company, so we don't do student loan companies anymore. We got burned by this type of industry, so we don't do. So even though, they might have only been burned once or twice, they'll stay away from a whole industry just because them individually have been burned. Now, this is what's nice about working with a lot of different lenders like we do, because we'll commonly find that one lender will not approve a customer while another lender will. And we see this with credit repair. A lot of our clients are credit repair companies, so they actually offer our business credit financing services. So they come to us for money, and we get a lot of these credit repair companies approved, even though they're a restricted industry with most lenders, just because we have pull with so many lenders, and we know lenders that will approve that industry. So when it comes to industry restrictions, it does have to do with the type of financing you're getting. It also really has to do with the individual funding source on who they restrict and who they actually don't. So some industries are almost always seen as high risk no matter what lender you apply actually through. So vices, for example, are almost always seen as high risk. So gambling, porn. If you're in those industries, almost any lender deems those as high-risk industries. Other industries, such as financial services, are restricted with many lending sources, but not all. So, for example, if you are an insurance agent, well, you're probably not going to get revenue financing or an advance at most places. They don't even like anybody in financial services, credit repair, bid lenders. They don't want anybody in cash advance space, insurance agent, real estate agents, mortgage brokers. They just don't even like anybody in financial services. Whereas SBA and loans and credit cards, they don't even care about financial services industries. So it really has to do. Some lending sources just restrict industries altogether while others don't. So financial services can include credit repair, lenders, accountants, insurance agents, mortgage brokers, realtors, and anyone else dealing with any type of financial transaction can actually fall into this bucket of financial services, which can be a restricted industry in a lot of cases. So always ask up front if the lender views your industry as high risk. Look, it's worth it. I've seen people go through this entire application process and then to find out, well, we won't do it because you're in a high-risk industry. Well, why didn't you just tell me that up front? Well, you didn't ask. So, again, we tell our customers up front, you're in a high-risk industry, this is a long shot or no problem, but you still should ask up front. Is my industry on your restricted list? Is this an industry you don't like to lend to, one that you deem to be high risk? And if they say yes, you might want to check another source before you even apply, because unless you have some pretty strong compensating factors, they're not going to usually do a high risk industry. So let me give you an example. We had a credit repair company that we got done not too long ago. I think we've got like 200,000 plus for this company so far. Okay, credit repair. They tried other places. They got denied because they were on the restricted list. We got them done because they had been in business a long time. They managed their bank account well. The owner had good credit. So there were several compensating factors that we said, hey, you might not like the industry, but look at all of these strengths. So the more strengths you have as compensating factors can also help you in some cases get past this high risk, but it's good to know up front that you're high risk before you even apply. So credit scores. No matter what you're told, personal credit always matters unless it isn't being looked at all. Business credit's a perfect example. Like, when I tell people they can get business credit with no personal, even with bad personal credit, like a lot of people are skeptical. But it's possible because you don't even put your social security number on the application. So when they can't even look at your personal credit, they obviously can't use that enough as a factor in your approval. But business credit's a very rare exception. It's one of the only kinds of real credit financing that's out there that you can secure without your personal credit even being pulled. In any other case, your credit will matter. So for example, when you apply for business credit, you could use your EIN to get approved and leave your social off the application. When you do this, your personal credit isn't even looked at, nor is it used for the lending decision. But this is about the only exception in the funding space where this actually happens. All other types of financing, including advances, look at and care about your personal credit. Yes, you can be approved for cash flow financing and merchant advances with bad credit. It actually happens quite a bit. So merchant advances, cash flow financing, we get those done. Our average customer has less than a 600 credit score. We've got credit for companies down to 520. We've seen 580 business owners secure over $1 million. So you can definitely get money with challenge credit, but the terms aren't going to be as favorable if you don't have good credit. So yes, you can get approved, but your terms would be much better if you had better credit. Now, don't wait till your credit's good to apply. That could take like a long time. You sometimes take what you can get, but just keep in mind that the terms you pay will be determined based on risk, and when it comes to personal credit, it will factor in to your overall risk. SBA loans, conventional loans, most other long-term loans and credit lines do require good credit for approval in most cases. Some, like advances, won't. Okay, so that being said, a lot of them will not. You know, a lot of them won't lend you money unless you have personal credit, like SBA loans. You go into your bank, they're going to require good credit, all those type of things. Okay, but in a lot of other cases, you can get approved even with challenge credit, especially if you have collateral, cash flow, things like that. Now, I don't have time for a bunch of questions because I have another webinar right after this. So I will put up my email and phone number to answer your questions. But somebody did just type in, does OnDeck deal with credit repair companies? And the answer is no. OnDeck doesn't deal with credit repair companies. We've tried to run through them with them before, and we haven't really had any success, even with strong compensating factors, but there are a lot of other sources out there that do. So collateral and asset-based type financing doesn't care about personal credit as much. This if the financing only looks at collateral for approval, not financing where collateral is required for approval. So an SBA loan is a type of loan where you have to have collateral to get approved. They care about personal credit. But if you're getting 401k financing, using your 401k as collateral, and that collateral being the type of financing you're getting, then your personal credit doesn't matter. So that's pretty cool because you could get 401k financing at a 4% interest rate even with 350 credit scores. You could get account receivable financing at a 1.5% discount rate even if you have 350 credit scores. So if you go into an asset or collateral-based type of funding product, then you actually can get approved for money where your credit really doesn't factor in that much because they don't really care. Like, you know, if you default, they just take your collateral and they get their money back right away, so it's not as big of a deal. But SBA loans, where you're only collateralizing a portion of the actual loan, can actually create problems for you. So there's no Fair Credit Reporting Act in the business world, so lenders will never disclose to you that they do pull your business credit when applying for financing, but they do pull your business credit. So just think, you're applying for money for your business, and your business has its own credit profile and score. So of course they're going to pull it. Like, a lot of people think they won't and they don't have business credit, but yeah, I mean, you're getting money for your business. Your business has a credit report. They're going to pull the business credit report. Okay, so make sure that you have your business credit profile established because that really ties in with getting approved for a lot of different financing. Not having established business credit makes you look like a rookie, a startup, a non-established business. Okay, that automatically leads to denial in a lot of cases. So ensure you have 5 to 10 reported accounts and a good business credit score, like Paydex score, so that reflects you're paying them as agreed, so you will have a good business credit profile. Now, you actually have 3 types of credit. A lot of people don't know this. You have your personal credit, You have corporate credit, which is a business credit that's linked to your EIN, and you have bank credit. Okay, so you actually have the banks actually have their own internal credit scoring system for your business called bank credit. Okay, and all three have to be good or should be good to give you the best chance of approval. Now, if you're going for an advance or a credit card, they don't care about bank credit or business credit. But if you're applying for an SBA loan, well, SBA even says on their website that you should have good credit in all three of these areas to get approved. So again, your higher level loans, your credit lines that are $250,000, they're going to want to see good credit in all three of these areas, whereas collateral based lending or something that's just looking at your cash flow really won't require that you be good in all three of these areas to actually get approved. So your bank rating is what your bank credit is actually called, is mostly based on the amount of money you keep in your bank account over the last 90 days. So a high 5 account means you have about 70 to 100,000 in there. A mid 5 is that you have 40 to 70 in there. A low 5 gives you 10 to 39,000. This is where you want to be. To have a good bank credit, you should have a 5 score. And a 5 score starts with you keeping an average balance of 10 grand or more in your bank account. Somebody said this to me the other day. They go, I keep a bunch of money in my bank account to have good business credit. And I said, well, actually, that doesn't help your business credit at all. It helps your bank credit, and we had that discussion. So it's important to know that having a bunch of money in your bank account doesn't help your personal or your business credit scores, but it is completely what your business banking score is based on, what your bank rating is based on. And here's how it breaks down beyond that. You could have a 4 depending on, if you have $1,000 average on the account to 7,000, you're in the 4s. You don't want to be in the 4s. You want to be in the 5s. So again, does this matter? Are you applying with a bank for bank financing? Then yes, it does. If you're going for a collateral-based financing like account receivable financing or equipment financing, not so much. But if you try to go to your bank and get an SBA loan, yeah, it matters a lot because you're getting money in a bank. So the one thing they're going to look at is their own internal bank credit scoring system to see where you stand. If you're in the 5s, you have a good chance of getting approved. High 5s, really good chance. 4s, not so much. So funding approval timeframes. The higher dollar amount or line you secure, the longer it's going to take to underwrite, no matter what type of financing you're applying for. Loans usually take 30 to 90 days or more. Credit lines usually take about 30 to 90 days or more. Advances are very fast, 7 days or less. Credit cards, I missed a D there, usually takes 3 weeks or less to actually secure. So it gives you an idea of time frame. So if you want fast money, advances are your first. If you want the second fast, credit cards. All the credit cards we talked about are best. If you really have good financials, good everything, you want more money and you want to wait it out, then 30 to 90 days for loans and high limit credit lines. Due diligence checks. Just talked about this today. I'll tell you what happened. All lenders will do a due diligence check on you and your application. They will look to see if you have other outstanding loans you neglected to mention on your app. They will check to make sure your lease or mortgage is in good standing. We just had one of these declined. We got the person through the entire process, and they do a due diligence check in the end. They contacted the landlord. The landlord said, heck no, this guy doesn't pay me. He's 3 months behind, and when he does pay, he's sporadic on his payments. Denied. Done. Whole underwriting process was done. Guy was going to have his money tomorrow, and the deal just got pulled either yesterday or today because his landlord trashed him in the lender's review. So they do these due diligence checks, and this is exactly why don't count your chickens before they hatch. Don't go try to spend the money you think you're going to get because it's not done until the money is in your bank account. And one of the last things they do is this due diligence check, and I've seen many of deals get denied here. One company got all the way to the end. They went to their website said they were going out of business. Done. Declined. It's crazy how many obvious things that we see that the person thinks they can get away with and doesn't. But these due diligence checks will always come at the very last. And if there's anything outstanding, you lied, you misled them, you have outstanding loans they don't know about, you're defaulting on your mortgage or lease payments, any of those type of things can lead to this. They will look to see if you're going out of business, like I said on the website. They will even look at your online reputation. Like, if you're going out of business, then the good chances are good that you stop delivering your services and all of a sudden your BBB and ripoff report starts getting bad. So they will check this stuff out. They look at your online reputation. Are you going out of business? How's your mortgage lease in good standing? And these checks are done in the very end, so you've got to make sure that you're solid in these areas. The purpose of this check is to find hidden risks that they couldn't find on the application. Okay, and the other purpose is to see if you left information off the application intentionally, if you lied to them, basically. So make sure you disclose everything you're asked to, otherwise lenders will find out about it. I never ceases to amaze me. We do a lot of advances for clients, and one of the biggest things we see is they have an outstanding advance that they don't acknowledge on the application they have. The lender knows about it immediately and declines the application because the customer lied. Don't try to keep this stuff from the lender, okay? And this is why it's good to have a middleman involved. Like, what I like about our finance division is they work between the customer and the lender. So they can help the customer make sure that they're putting the right things on the application, that they're disclosing what needs to be disclosed, and the customer can openly talk to them about what's going on and get advice and consultation about how to proceed. Whereas if you're just going with the lender direct, it's kind of hit or miss. You have to just give them the info and hope it pans out well. But you've got to make sure you disclose everything you're asked to, otherwise the lenders will find out about it. These checks usually take about 1 to 3 days to complete. It usually happens same day at the very end of the process. So what type of financing should you apply for? Now that I've done an extremely good job of completely confusing you with a lot of different kind of financing, now let's get to the nuts and bolts. What should you actually be applying for? Well, there's a lot of different types of financing out there, as we talked about. There's so many options that you might not even know where to start. So let's take a look at some of these available options. First, let's talk about your bank, because when I ask business owners where they go when they need money, this is what they say: I go to my bank. But according to the Department of Revenue, what you'll be surprised to find is that only 1.1% of all business funding comes from conventional banks, such as SBA loans. And this still blows me away. And this is what we are trying to change in the industry. We want to be the name that when you think about business financing, you think about us. Because nowadays, when you think about business financing or credit, you think about going to your bank. But the problem is they only account for a little over 1% of all business financing that takes place. They're not the best source of business. So if you go try to get that kind of money, you're probably going to get denied. So your bank can help you with credit lines and loans, but you have to have financials and good credit and collateral for approval. Okay, you can Google SBA loan approval checklist to find this page here. Okay, and that's exactly what you can Google. SBA loan approval checklist, and you'll find some link called sba.gov content/business-loan-checklist. Check it out. That's everything you have to qualify for a conventional loan or an SBA loan at your bank. And if you look through that, you're probably going to find that you probably won't meet that criteria. Very few people even do. These are very hard loans to get. So trying to go to your bank to get money is going to be a tough road. Okay, that lists all that you'll need on the approval on that page. Now, most business financing that does take place comes from these alternative lending sources. These are lenders who've carved out niches in the business funding world. They typically focus like on one aspect of your business instead of your business in its entirety. And if that one area of your business is strong, well, then you can get approved even if you're weak in other areas. This is not the same as with your bank. If you go to your bank, you have to be good in all areas, which most companies aren't. But with alternative financing, you can be strong in one area and be weak in others and still get approved. Okay, very different than SBA loans. So alternative lending is much easier to secure than conventional loans. You can usually get approved and funded much faster also. And the terms aren't as favorable because the risk is much higher. Okay, but you can often get approved when your bank says no. Okay, so alternative lending is much easier to secure than conventional loans, and you can easily get approved and funded much faster, which I just said. And I don't even know. I think I just actually have two of the same slide there. So we've discussed several different types of funding that are available based on your actual credit. Some use your, and let me go back. So when we talk about alternative lending, that is your collateral-based lending. I guess I kind of bunched that in here. It's also cash flow financing. It's merchant advances. It's more of the advanced kind of funding than actual loans and credit lines. Then you've got credit-based financing. So this is alternative. This works really well if you have cash flow, like bank statements, verified. But if you have good credit or a good credit partner, then we talked about a lot of those options that work off of credit. So some use your business credit for approval, as we talked about. Others use personal. Okay, you can't go into your bank and get this kind of credit, you really should go through a lending source. You'll get a fifth of what you could get. But there are lenders who focus on that type of financing only, and they get you multiple high limit cards as we talked about earlier. Remember, you've got to have good credit here or good business credit to get approved for unsecured credit-based kind of programs. Okay, then again, there's the third type. There's collateral-based funding. So with collateral-based funding, collateral-based lenders basically lend you money because you have assets. They can approve you for money even with bad credit, even if you just opened your business. The key is that you need to have acceptable collateral to actually qualify. So that could be 401k and stocks, inventory, equipment, real estate, a book of business for insurance agents, car lot inventory, purchase orders, account receivables, commercial signs, graphic wraps, any other kind of viable form of real asset or collateral you have very well might work. Vehicles are depreciating assets, so they usually won't qualify. Rates and terms on collateral-based financing are very good. Like I said, I mentioned some earlier that were 1.5%, 2, 3, 4% rates. Okay, it's not uncommon to get rates of 5% or less, even with horrible personal credit, because if you default, the lender just takes your collateral. So there's not a lot of risk with that kind of financing. Financing based on cash flow. Now again, I guess when I said alternative financing before, I was kind of grouping a lot of these things together. Now I'm kind of getting into the specifics of that. So you've got, again, we talked about the collateral-based financing. We talked about credit-based financing. Now we'll talk about cash flow-based financing. So most advances are forms of cash flow-based financing. Fastest and easiest way to get money, get approved with bad credit, no collateral, but you're going to need to show bank statements, and you're going to have $10,000 a month in monthly revenue coming in, and at least 6 monthly transactions to typically get approved. And you can usually get about 12% of whatever your annual revenue is. Okay, there are cash advances. So keep in mind the rates aren't going to be good. Like if you think about Amscot, they deal with cash advances too. Rates aren't good on cash advances. They could be 8% to 40, 45% because it's high risk money. Okay, but again, if you're worried about not being able to afford that, that's not the case. When I talk to a lender, usually their collection rate is less than 10%, 9% or less. So they do this in a very smart way where it definitely works for most people that they secure the money for, even though the rates are higher. You'll usually be approved for 6 to 18 month payback term. Once you prove yourself at the first advance, you'll get better terms. And a lot of people that get their first advance come back every 3 to 6 months and get more and more and more money. Matter of fact, 80% of our clients that we see do that. And that's why you find that 70% of the industry get their first advance and come back for more money. So final thoughts. Look, there's a lot of money available out there for business owners, more now than really there's ever been in the past. You just need to know what type of financing to go after. Once you have an idea of whether or not you want to go for collateral-based lending or cash flow-based lending or credit-based lending, then you stand a good chance of getting approved versus bank-type lending, which you don't stand a good chance of getting approved. So make sure you set up your business credibly. Some of the things we talked about to address on the application before applying to have the best chance of getting approved. And also, keep in mind, we offer all this type of financing and credit discussed. So, if we can help you with any of that kind of financing, let us know. Like we have all this different type of financing out there, or you can find it individually on your own. But again, what you'll find is most lenders out there offer 1 or 2 kinds of financing, not at all. But that's okay, because now you know what to look for. Now that you know what kind of financing out there to look for, now you'll be able to find the kind of lenders that can offer you the kind of credit that you might be able to get. So hopefully, the kind of financing that you might be able to get. So hopefully that helps. You're going to get a playback of this webinar where you can go back and focus on the areas that you kind of meant the most to you, because I know I walked through kind of fast. I have limited time. If you have any questions, if we can help you at all with getting business credit financing, there's our number, 877-600-2487. You can also send me an email direct. I do respond to my emails, ty@creditsuite.com. And if you want more information on us, what we do, you can check us out, creditsuite.com/business credit. That'll introduce you to our partner opportunity where you can get credit financing for your business and help customers do the same. So as in all my webinars, I hope you got a lot of information out of this that can help you get financing for your business, because we're in the business of helping business owners succeed. So hopefully this helps you do so. And again, I'm going to go ahead and wrap this up because I have another webinar coming up in about 2 minutes. So if you have any questions, feel free to give us a call, send us an email. Thanks everybody very much for taking the time to attend this webinar.